All right, let's dive into a really fascinating idea surrounding Lululemon. Now, you've probably seen that the stock has taken an absolute beating lately, but one analysis we're digging into suggests that where most people are seeing fear, there might actually be a huge opportunity. So let's break it down.
And that right there is the million-dollar question, isn't it? When a huge premium brand like Lululemon sees its stock price just fall off a cliff, does that mean the company is fundamentally broken, or is the market just panicking, creating a super rare chance to buy in at a great price? That's the puzzle we're going to try and solve today.
Okay, so to get our bearings, the source material we're looking at has the stock trading at around $156 a share. Just kind of lock that number in your head for a second. Now, what's really interesting is that its recent 52-week low was only about $14 lower, down near 144. So you can see the stock is really just hugging that point of what you might call maximum pessimism. And this right here is where the whole opportunity starts to open up. The source points us to the options market, where the implied volatility is at a whopping 46%. Now, in plain English, that just means the market is expecting some big price swings. All that fear makes options really expensive, and that is the absolute key to the strategy we're about to walk through.
So, how do you take all that fear and potentially turn it into income? Well, the analysis we're looking at proposes a very specific option strategy. It's called selling cash-secured puts. So let's unpack what that actually is.
A cash-secured put. I know it sounds super complicated, but the concept is actually pretty simple. Think about it like this. You're basically telling someone, hey, I am willing to buy 100 shares of Lululemon from you, but at a price that's even lower than it is today. And just for making that promise, they pay you cash, right now, up front. It's kind of like getting paid to put in a lowball offer on a house that, honestly, you'd be happy to own anyway.
And the mechanics of it are surprisingly straightforward. First, you set aside the cash you'd need if you do end up buying the shares. Second, you sell that put option contract. And third, and this is the best part, you collect that cash premium immediately. After that, you just wait and see what happens.
Okay, so this isn't a one-size-fits-all kind of deal. The source material actually lays out two different ways you could approach this, all depending on your appetite for risk. There's the safe harbor path and the aggressive income path. Let's see how they stack up.
This chart lays it out perfectly. Look at the safe harbor strategy. You're agreeing to buy the stock at $135. That gives you this massive 13.5% buffer, meaning the stock has to fall quite a bit before you're on the hook to buy it. The trade-off? You get a smaller premium. Now look at the aggressive income play. The strike is much closer to the current price at $145. Your buffer is smaller for sure, but the potential premium you collect is more than double.
And here's a really important detail: the timeline. Both of these proposed trades are super short-term. They're targeting an expiration date that's just a little over a month away. The whole idea is to collect that premium, which is pumped up by all that fear, in a really short amount of time.
So the how is one thing, but the real question is why. Why does this strategy make any sense for Lululemon, specifically right now? I mean, the mechanics only work if you actually believe the stock is a good deal at these prices. So let's get into the core arguments for that.
And the first pillar of this whole argument comes straight from the playbook of the legendary investor Peter Lynch. The idea here is that the market is treating Lululemon like it's a failing business, a broken retailer. But if you actually peel back the layers and look at the numbers, the fundamental business still looks incredibly strong.
And you can see that so clearly right here. The stock is trading at a price-to-earnings ratio of just 11.6. That's not just low for Lululemon. That is the lowest valuation this company has had in more than a decade. It's way below what's historically been seen as a value level of 15 times earnings.
So why does that 15 number matter so much? Well, according to the source, history shows a really clear pattern. When the stock's valuation gets this cheap, the big players, we're talking large institutional investors, have historically jumped in to buy, which, as you can imagine, often pushes the price right back up.
But it's not just the big, anonymous institutions making moves. Take a look at this number: $494,000. What do you think that represents?
That is how much Lululemon stock the company's own interim co-CEO, Andre Maestrini, just bought with his own money. I mean, think about that. When the people who are actually running the company are buying big chunks of stock at these prices, that sends an incredibly powerful signal of confidence to the market. It helps create what investors call a psychological floor under the stock price.
Okay, so let's step back and connect all the dots. You've got high fear in the market, which is creating these really attractive options premiums. You've got a historically low valuation that, in the past, has been a magnet for big buyers. And you have company insiders putting their own money on the line. The core idea here is all about taking that widespread fear and turning it into a calculated opportunity.
So, what's the big picture playbook here? What are the key lessons we can take away from this whole analysis? First, intense market fear can create some seriously high-yield opportunities. Second, looking at historical valuation can give you a clue as to where a potential price floor might be. Third, always watch for insider buying. It is one of the strongest signals of confidence you can get. And finally, remember that clever strategies like selling puts can actually be a way to get paid while you wait.
And that kind of leaves us with one last thought to chew on. This way of thinking isn't just about Lululemon, it's a whole framework. So the next time you see the market completely freaking out and a great company's stock is getting hammered, ask yourself, is this a sign of a truly broken business, or is it just fear creating an incredible opportunity? In a market full of fear, where are you going to look for value?